Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young, and today is March 6, 2025, and we're going to talk about that sometimes discounted does not mean a bargain to buy. And what we're going to focus on specifically is not just the broad market, but specifically into the real estate sector with the sliding interest rates that we've seen over the last couple of weeks. So to begin, here's the S&P 500. Not only have we continued the sell-off today, as you can see right through here, we're about to break free from the monkey bar 20%, which has me looking for the next support level or next barrier to be tested at 563. So I'm looking for about another 8-point drop potentially in the S&P 500, and the biggest reason why is because we cleared the lows and have cleared out the move all the way back to the election bump. So if we clear this low, then there really isn't much to hold us back from going back and testing 563. Now that's the broad market. We know that the market has been weighed down and held down by the tech sector selling off quickly. But we've also seen a bounce and recovery in bonds and bond prices. So if we look at the Z and the bond futures have shown that we've had some demand kick in and we've pushed up to this overbought area. The 0 is the year and this 20% is the month, right up to that overbought area, and has pulled back. Now that rally in bond prices has seen a decline in yields, and there's been lots of speculation, lots of comments, lots of talk online and in our classes that people are saying, well, therefore the home builders and real estate are going to get a bump higher because the rates have fallen. I agree the rates have fallen, but they've only fallen about 0.6%, 0.6% when you go from 48 to 42. So 0.6% decline, 0.5% roughly, in lower interest rates is not enough to break this out of the channel of the trend. Part of the thing we're seeing is that behavior in housing. So the speculation has caused home builders to bounce off of their lows after putting in a new 52-week low, and there's lots of hope, and that bounce here on good volume has people looking at this as an opportunity to buy. I don't see it that way. I see it as there's maybe a discount, but that does not mean we're done falling. If we look at the home builders information, I had to go back last week and look at the home price index, new home sales, pending home sales. If we look at the data here on the home price index, it came in at home prices going up year over year, but the overall move in the trend in new home sales, the number of homes being sold, even though we already had the sliding interest rates, new home sales came in at 657, which was down about 3% from the expected and down from the previous month, down nearly 8%. So total sales 8% lower, and you can see that the trajectory has been lower highs, lower lows through here. If we get back below 600 and 500, new home sales are not doing great, and the rates were already slipping. So if we're pricing in the future, we probably shouldn't be betting on new home sales turning out positive for the new home construction companies that are seen in ITB. Pending home sales was really bad. So pending home sales, these are the existing home sales that are under contract, and we look at this, we went from negative 4.1 from the previous. We expected it to only be a decline of 0.9. It was negative 4.6. So looking at the percentage, month over month, we've had two very negative months. If we look at the revisions through here, most of these have been lower revisions. And so the data is showing that the pending home sales, existing home sales on the market are in decline as well. So new homes and existing homes, pending home sale contracts are really not showing the increase in demand that we would expect if the interest rates were really making a difference. So again, on this bounce, I would be looking at a retest of the previous support, the gap, and the resistance near 100 as potentially a barrier to go for another move lower. If we look at the real estate sector overall, real estate sector rallied, broke through support, and it's accelerated down, and this pullback in just 3 days has wiped out about 2 weeks. So 3 days down has wiped out 2 weeks, and it really could go back and test these lows near 40 and even 39, and if we break through that, this gap, then I'd be looking for a test of the gap down at 38, and we're talking about another 10% decline in real estate. Now, we don't have to go with one single ETF. We don't have to go with ITB. We don't have to go with XLRE. And we can certainly look at the breakdown today as confirmation that we're seeing the reversal of that uptrend into a downtrend. But this would be one where you might look at saying, okay, if we're seeing this weakness, one of the things that's in real estate, and we're seeing the weakness in technology, is to go look at those specialized REITs, those that are involved with the technology sector. And if we were to look at some of those stocks, we might be able to find some real opportunities to go bearish in those moves. Now, let's just take a look at a number of them. Maybe we could do American Medical Towers, but let's go with EQIX. And you can see break of support today. EQIX looks like it wants to go down at least the distance of $20 to not 30. And this breakout through here goes from 50 to 896, 892. So we may go $60 lower, which would mean 830, 850, and then I'd be looking for a move down into this area right here, 830, 850, somewhere in here. So Equinix is pushing for 830 at this point, the way I read that. Digital Realty, DLR, also a real estate company, a real estate REIT that is tied to the technology sector. We've already reversed from 200 to 150. So we're down 25% today off of the highs, and today we're accelerating through the downside, through that short-term support. If we break through 147, I don't see any reason not to go to 135, and if we go through 135, we're looking at an additional drop, I would say at least another 20% decline in Digital Realty. These are the ones that I'd be looking at for bearishness and pushing these things to the next lower level. SBA Communications, I would not worry about that one. The cellular companies and things like that, don't worry too much about those. I would be focused on those that are providing the tech sector their real estate. And what's nice is on something like Digital Realty, if you were to sell the 150 or 155 call and a call vertical, you can actually get a bearish short call vertical trade here where you can sell the 155 and buy the 160 and get a $1.20 credit on a $5 wide spread with a delta that you're selling at 34, which means you have a 66% probability of keeping that premium as long as it stays below 155. And that's a pretty decent scenario because we have the top of this candle that would allow you to do that. So short call vertical potential at 155, 160 for the March 28th expiration. And we could do this on home builders as well. If we go to take a look at ITB, we'd look for the weakest of the week, and Toll Brothers is one of those. And I'd say the gap filled here is likely to be defended, and so we can probably put a short call at 112, 115 on a retest, if we even get there. So I'm just looking for this to get up here and test 115. If it tests 115, then I'd be looking at selling the premium up at 120, 119, 120. If we get to 115, we should be able to sell that 120 a $1 wide or $2 wide vertical, and that vertical at 120, 121, if we test 115, should give us 30 cents to 35 cents versus the $65 risk, and that's still going to give you the similar probabilities and similar reward to risk ratio on selling verticals up here near the top. So waiting for these to retest on the home builders, but not necessarily waiting for them to test on those tech sector REITs that we're seeing in XLRE under specialized REITs like DLR and EQIX. They're providing some really decent premium on short verticals, and will give you some barriers that you can use on the way down. Now, as we're watching these again, if you're looking at this and saying, but therefore, where do I want to be? Still watching for oil and energy to base out here. I still like oil at 66 to 76. We're currently at 66.55. We're trying to bounce here at these lows. And so it might mean that I'm going to be looking for energy again, and I'm still not moving away from the fact that consumer staples is one of the best, safest places to be. We pulled back, we bounced yesterday, and today's giving us a confirmation on consumer staples to push back up into the next levels. But right now, real estate's getting knocked down. I wouldn't trust the fact that the rates are low enough that would justify future growth. And if we take one more look at bonds and ZN, bonds and ZN are trying to bounce today. You could wait for this to bounce higher, and if it goes higher, then maybe you see the pricing in of lower rates helping those, but right now, this is not a confirmed bounce. It is a pullback, which means slightly higher rates, and we're not really getting the confirmation in bonds. And even though we had higher bond prices and lower rates, that 0.5% to 0.6% was not enough to save the real estate sector, either in home builders or in the specialized REITs. That's going to do it for me today. Join me again tomorrow morning, and we will talk about non-farm payroll. Otherwise, have a fantastic night.